When a shareholder of a Canadian-controlled private corporation passes away, the government will come after the money twice. But as much as the Income Tax Act enables the state to penalize wealth, it also enables taxpayers to mitigate against their tax bill if they follow the provisions within the Act. This video is specifically made for business owners of small Canadian privately held corporations and their tax professionals who are considering some options, including the use of a corporately owned life insurance policy in their overall tax planning strategy. When using a corporately owned life insurance in respect of post-mortem planning, this can add a significant value to mitigating against the tax bill that would normally be payable on your passing away. Have you ever wondered why Canada's Tax Act makes it so difficult for entrepreneurs to be able to pass along their wealth to the next generation? Canada's tax system is a perfect example about how this works. When the shareholder of a Canadian-controlled private corporation passes away, CRA will come after the same wealth and tax it twice. And as Austrian economist Ludwig von Mises reminds us, taxation is a process where it penalizes the productive members of society, moves that money into the government coffers where it is used less efficiently than if it was left in the hands of the people who are producing. And double taxation on death is a clear example of this wealth confiscation. And before I dive in, I'd like to encourage you that if this video is going to provide any value to you whatsoever, I'd encourage you to like, subscribe, and hit that notification bell and help this channel out in growing its membership. So here's the problem in plain English. Now, when you pass away, the tax system will pretend that you have sold all your assets at their fair market value. This will create a capital gain on shares of a private corporation in your terminal tax return. But when the beneficiaries of your estate go to redeem those shares for the cash that's still sitting inside or any other assets that are sitting inside your CCPC or Canadian controlled private corporation, those are taxed again as a dividend. Same value, two taxes. It's what writer Frederick Bastiat called plunder. Now, thankfully, there's a provision in the Income Tax Act that will significantly help against this double taxation problem. Under the Income Tax Act, Subsection 164(6), if the estate redeems those corporate shares within a specified period of time, that creates a capital loss which can be written back against the capital gain. This effectively wipes out the first layer of tax. Now, in order to execute this, it's very important, crucial, that your will specifically allows or empowers your executor to work with the accountant in this case to execute on this 164(6) plan. Now, recent legislative changes is expanding this window. It used to be that the executor could only have 12 months in order to execute this plan. But under Budget 2025, that is being expanded to a 3-year window. And if you remember, this was originally proposed in 2024. Now, this window brings some opportunities for the executor and the estate to reduce some of these tax burdens, but it also means likely that CRA and the courts will scrutinize the legal authority for the executor to be able to perform this type of planning, which means it's very important to have your will updated or at least reviewed by a legal professional to make sure that the wording is consistent with the executor's ability to be able to take these alternatives. Now, Subsection 164(6) isn't the only tool in the toolbox. There's something else called pipeline planning. So instead of redeeming the shares, pipeline planning allows the estate to reorganize itself and do a corporate reorganization. The idea under a pipeline is instead of a taxable dividend, the estate is simply, or the reorganization is simply allowing for the repayment of capital out of the corporation. So in short, here's how this works. The estate transferred the deceased's shares into a new corporation. That corporation gets a stepped up cost base equal to the fair market value at death, and the estate can extract funds as a repayment of a shareholder debt. So what's the result? There's only one layer of tax paid, which is the capital gains payable on the death of the shareholder. That secondary layer of dividend tax is avoided completely. Now, pipeline planning takes patience. It takes the proper legal and tax structure, so you do need to involve lawyers and accountants, which you should be doing anyway. But it does allow the estate to avoid this double taxation trap. But it doesn't really matter what the accountant and the lawyer are going to suggest to the executor. Whether you use 164.6 or pipeline planning, there's still one more issue, and that issue is liquidity. Where does the cash come to either pay the taxes or fulfill the reorganization? And this is where corporately owned life insurance adds a tremendous amount of value. It provides immediate liquidity on death and creates a credit to the capital dividend account, or the CDA. The CDA allows a tax-free dividend payment to your heirs, and that keeps more capital in your family. That means that your family receives as much tax-free capital as possible, avoids fire sales, and keeps the money where it should be going, which is to your family or maybe even potentially to another beneficiary. Now, a word of caution, if you're using 164.6, you also have to manage the 50% rule. If you decide to declare 100% of that dividend as being tax-free, CRA will grind down the capital loss. The fix is a 50% solution, meaning 50% is tax-free and 50% is taxable. This keeps your loss carryback intact and preserves more of your CDA. Now, neither 164.6 or pipeline planning, or quite frankly life insurance, is a panacea or a magic pill. Every strategy, every decision carries with it a correlating consequence. Sometimes those consequences are beneficial, and some of those consequences have drawbacks. So let's quickly walk through some of the drawbacks, or at least some of the considerations of 164.6, of pipeline planning, and of corporately owned life insurance. Under the updated rules, as I mentioned, they're extending the window to be able to perform these 164.6 transactions from 1 to 3 years. However, if things are moving slowly or there's challenges between the accountant and the executor, the opportunity can still be lost. The stop loss rules can grind down that capital loss if you're not managing that dividend payment properly. And even with the strategy, you still need to find the liquidity to make this happen. Corporately owned life insurance could be a solution for that, and we'll get into that in a minute. Now let's turn to the consequences or drawbacks of pipeline planning. Pipeline planning takes time and patience. If the funds are withdrawn too quickly, CRA may characterize them as dividends and effectively kill the strategy. Pipeline planning is also on CRA's radar. Aggressive pipelines can be challenged under the General Anti-Avoidance Rules, or GAR. This is especially true for inter vivos pipeline planning, or pipeline planning essentially that is done during the lifetime of the shareholder. Pipeline planning can be pretty expensive. You're looking at possible significant costs, both from a legal and tax perspective. And just like 164.6 planning, pipeline planning still requires some liquidity to come from somewhere, either the sale of an asset or using a corporately owned life insurance policy. This is not necessarily a drawback, it's just a factor in the planning overall. Now, corporately owned life insurance is not a panacea either. The premiums can be quite substantial, especially if a shareholder has a health-related issue or is uninsurable. If the policy is not structured correctly, the credit to the capital dividend account may be lower than expected. And let's be honest, circumstances change all the time. If the business is sold or wound down, corporately owned life insurance for the purposes of the 164.6 or pipeline planning may not be as effective. In fact, it may not be the proper use of the funds at all. There are a lot of entrepreneurs that approach me on the tax benefits of accumulating capital in a life insurance contract, but the use of a product has to be driven by the proper strategy that's being recommended. And that recommendation of strategy all comes down to having a proper plan. In order to put the proper policy in place for 164.6 or pipeline planning, it is very typical that permanent insurance plans are being used, either a universal life or a whole life policy. Either way, either a universal life or a whole life plan has the added value of accumulating capital on a tax-exempt basis in the contract. That means you can double up or even triple up the benefits in your corporately owned policy. Here's a few examples. You are legally able, up to certain limits, hold some corporate capital in these corporately owned policies. As an alternative to a savings account or a bond portfolio or a GIC in your corporation, these assets are all taxed punitively. And in British Columbia, for example, the rate of tax on every dollar of interest or any other passive income is taxed at almost 51%. However, by holding the capital inside your tax-exempt insurance contract, this is a tax-free accumulation of the money, and it also can provide with an increased death benefit. Some entrepreneurs use their corporately owned life insurance policy to fund a discretionary defined contribution pension plan. Unlike a traditional pension plan, these payments or these contributions or premiums to a life insurance policy are not tax deductible, but you can have tax-free access to the money depending on how you're using it. This is typically accomplished with leveraging against the capital inside the corporately owned life insurance policy and using it to pay a taxable dividend. Now, some of the benefits of doing that is you can actually increase some of the deductions. There may be a partial premium deduction if you're still paying premiums. There's an interest deduction going along with that, but the payment of a taxable dividend to the shareholder also allows for the recapture of the RDTOH credit embedded and possibly been building up in that corporation for many years. Now, to be sure, the payment of a taxable dividend to the shareholder, regardless if it's being leveraged or not, will still affect the RDTOH credit. The third benefit is that this corporate liquidity that's being stored inside the insurance contract can be tapped into at any time during the lifetime of the shareholder. Now, the shareholder may require liquidity for business interruption or macroeconomic reasons that are affecting the cash flow of the business. There may be investments that you want to make or equipment to purchase or expansion of a business. These capital values inside the insurance contract can be tapped in for any reason. It doesn't matter why the shareholder needs the money. The shareholder can go in and borrow against that money. For those of you familiar with the immediate financing arrangement, think about this as being an immediate financing arrangement that's neither immediate and it is discretionary based on the needs of the shareholder. So what other issues are out there? Well, this certainly is not a comprehensive list. And I should be very clear that it's not a recommendation to choose one path or the other. Some of the other strategies that you may want to consider in consultation with your estate financial, tax, and legal professionals are things like estate freezes. Very simply, an estate freeze is where you lock in the values of your embedded capital gains, defer them and for a future time, and take any future growth of that business and give that future growth to the future generations. Through the effective use of planning with trust, there is the ability to multiply the lifetime capital gains exemption. In my view, if you're going to do any sort of trust planning, only consider using a trust and estate practitioner, somebody carrying the TEP designation. You could possibly do some gifting during your lifetime, either to beneficiaries or to charities. You essentially reduce the taxes paid on a deemed disposition on death by bringing that forward and paying for a smaller amount today. You could sell your business and pay all the taxes due today. Selling your business now or at any time that you decide gives you control and the valuation that you can choose at your discretion. And also, you can effectively use debt planning as a way to mitigate against tax. So what's the takeaway here? The takeaway is that there is no silver bullet. Each strategy, each tool that you use comes with its own risk-reward trade-offs. Here's typically what I see often being recommended by legal, tax, and estate professionals such as myself. The best approach is usually a layered approach. Use 164 or pipeline planning for tax efficiency. Consider using estate freezes for long-term intergenerational transfers, and add in life insurance to provide liquidity and CDA credits. At the end of the day, these strategies exist to protect your family capital from government confiscation. So let's take a step back and look at this another way. Without 164.6, without pipeline planning, without life insurance, the estate is likely going to pay double tax. Also with life insurance, depending on the assets inside the company, there may be either no CDA credit and certainly no liquidity. So with careful collaborative planning, the use of tax planning, legal planning, and insurance planning, you reduce risk, eliminate double taxation, and preserve your wealth. And that's what Austrian economics points to. Protecting private property, protecting capital, and keeping wealth in the families who build wealth and opportunity for other Canadians, not governments who may effectively waste it. Smart planning isn't about fooling or tricking the system. Smart planning is using the system to your benefit.